Welcome to This Explainer. Today, we are diving into the absolute freefall of one of North America's biggest private farming empires. I mean, the sheer speed of this unraveling. It is literally breathtaking. We're talking about Monette Farms, a titan of modern agriculture that, well, seemingly had it all, until, suddenly, they didn't.
Let's just start right here with this absolutely staggering number, $1.08 billion. That was the total liabilities hanging around Monette Farms' neck by late 2025 as they frantically scrambled to survive. Just to put that into perspective for you, this is a farming operation carrying the kind of debt you'd expect from a major international airline. They went all in on this aggressive debt-fueled land grab. But when the economy shifted, that massive leverage basically turned into an inescapable anchor.
And that crushing weight pushed them right into a corner. In April 2026, they had to file for bankruptcy protection just to keep the lights on and the tractors running. Seriously, when a player of this size hits a wall, the shockwaves ripple through the entire agricultural sector. It's this harsh, classic story of an aggressive growth strategy slamming headfirst into a new reality of high interest rates and volatile commodity markets. Okay, to really wrap our heads around how this happened, here is our agenda. We're going to cover the billion-dollar collapse itself, the seeds of the crisis, their desperate sale program, the April 2026 tipping point, and finally, the emergency lifelines and fallout.
Section 1. The billion-dollar farming collapse. Let's look at the Monette Empire.
You have to understand, Monette Farms was not some quaint family farm. This was a sprawling corporate behemoth, over 400,000 acres. They were pulling in hundreds of millions in revenue from grain, produce, cattle, you name it. Under CEO Daryl Monette, they operated across Alberta, Saskatchewan, Manitoba, British Columbia, and even pushed deep into the U.S. down in Montana, Colorado, and Arizona. They weren't just farming. They were running a massive continental logistics network. Now, to understand the whole April 2026 situation, we need to quickly define CCAA. It stands for the Companies' Creditors Arrangement Act. Basically, it's a Canadian legal shield. When Monette filed for this, they weren't liquidating and closing up shop right that second. No, they were basically begging the court for a timeout, a pause button, so the massive syndicate of banks breathing down their necks couldn't just swoop in and chop up those 400,000 acres overnight. Moving to Section 2, Seeds of the Crisis. Let's look at the early warning signs. The cracks really started showing in their 2024 financials. That aggressive growth we talked about, it completely backfired, dumping them into a devastating $73.1 million net loss. Their EBITDA, which is earnings before interest, taxes, depreciation, and amortization, tanked to just $37 million. Now, I know $37 million sounds like a lot of cash, right? But when you're sitting on over $1 billion in high-interest loans, that doesn't even cover your bare minimum interest payments. They were officially hemorrhaging money. But here is the craziest part. They actually had an escape route. Back in March 2021, Daryl Monette signed a term sheet to sell 75% of the company to a group called LBJ for $400 million. This would have been the exact capital injection they desperately needed to fix their balance sheet, but the deal completely fell apart. So without that outside cash, they were trapped, totally at the mercy of their lenders and wild commodity prices. This perfectly captures the trap they were in. They simply couldn't borrow their way out of the slump because their debt was already astronomical. Meanwhile, the real estate values that had historically backed all their loans were flatlining. Add in spiking inflation, skyrocketing costs for things like fertilizer, and sky-high interest rates, it was literally the perfect financial storm. Their capital structure was totally doomed. Section 3. The Desperate Sale Program. Selling to Survive. By early 2026, the panic had clearly set in. They initiated a pre-CCAA sale program, frantically carving off huge pieces of the company just to appease the lenders. Phase 1 was all about these mega sales. They dumped the Regina Island for $71 million and their Haverland down in Montana for $47.5 million. But get this, they sold the 12,900-acre Stewart Valley farm for $54 million. That is 158% over its 2025 appraised value. Absolutely wild. But honestly, the financial hole they were in was just way too deep. And we're not just talking about abstract spreadsheet numbers here. Looking at the Admiral Saskatchewan blocks tendered for sale, they were literally liquidating the very dirt that built the empire. For Phase 2, they launched an interactive website, basically putting everything up for grabs. They set a hard deadline of March 2nd, 2026 for offers on over 1,300 quarter sections of farmland. It was a total, desperate fire sale to raise cash before the banks pulled the plug. Section 4. The April 2026 tipping point. The final collapse. This timeline right here is basically the ticking clock of their demise. A brutal 5-day stretch where nearly $1 billion came due and they had zero cash to pay it. On April 15th, their massive $950 million syndicate debt officially matured. They couldn't pay. The very next day, April 16th, Farm Credit Canada demanded over $11 million for their cattle operations. With the walls completely closing in, on April 20th, Monette finally filed for CCAA protection. Faced with this wall of debt, CEO Daryl Monette put out a statement saying this court process allowed them to address the pressure while focusing on their people and keeping the farms running. Now, sure, that's a carefully crafted PR statement, but it really does highlight the human element. Without that court protection, bank accounts freeze, paychecks bounce, and hundreds of farm workers get stranded right at the dawn of the crucial spring planting season. Finally, Section 5, Emergency Lifelines and Fallout. So, to keep those tractors moving, they urgently needed something called DIP financing, debtor in possession. It's basically a super priority emergency lifeline from the court. Because, let's be real, no bank is giving money to a bankrupt company without an absolute guarantee they're first in line to get paid back. If Monette didn't get this DIP money instantly, they wouldn't have cash for seeds, fuel, or fertilizer for the 2026 season. And if a farm doesn't plant in the spring, that land becomes practically worthless. Look at this mind-boggling contrast. A giant that had racked up $1.08 billion in liabilities was suddenly begging the court for a measly $40 million emergency draw, just to put seeds in the dirt. The court did eventually authorize up to $90 million, but that first $40 million was the absolute bare minimum needed to keep their remaining 350,000 acres alive. It's just wild to think about a billion-dollar empire completely starved of cash like that. And even with the court protecting them, the fallout has been absolutely brutal. We're seeing continued liquidations, like the recent Hafford sale for $29 million. Every single financial move is now micromanaged by their court-appointed monitor, FTI Consulting. But honestly, the most devastating blow operationally, they lost their primary elevator grain license. Without that, they can't even efficiently process or move their own grain. It completely cripples the core of their business. Which leaves us with this huge, lingering question. With the empire totally fractured and operating under court protection, what is the ultimate future of these 400,000 acres of prime farmland? When this CCAA process finally ends, does Monette Farms somehow survive as a tiny fraction of its former self, or do corporate competitors just swoop in and carve up the dirt? The map of North American agriculture is literally changing right before our eyes. The only question now is, who gets the dirt?